Hi everyone, welcome to my channel. I'm Doris and I'm here to share with you about what happened to my account and also the market updates. Today my account made a loss of $2,733 and I'm going to also go over the December meeting of the Federal Reserve as they published the meeting record. Last, the projections the financial industry has for the US economy. Today my account made a total loss of $2,321 and that's a decrease of 2.28%. For my SQQQ, I lost $741 today as the share decreased 1.34%. For my DRV, I lost $1,580 today, and that's a total loss of 8.68% after the market. Before the market closed, it dropped 6.95% to $49.93. Looking at the market today, Dow Jones Industrial Average rose $133.4 to 33,269.77. Nasdaq Composite rose 71.78 or 0.69% to 10,458.76. And S&P 500 rose 0.75% or 23.83 to 3,852.97. All of the market indexes showed a positive growth. And looking at the industries in general, most of the industries rose except for healthcare, software infrastructure, internet connection and information, oil and gas, specialty. The healthcare dropped 2.44% as United Health Group dropped 2.73%. Software infrastructure dropped 2.36% as Microsoft dropped 4.37% after an analyst downgraded Microsoft from buy to neutral due to its poor cloud information performance from Microsoft's Azure. Back to the Federal Reserve's convention. There is a general agreement that a restrictive policy stance needs to be maintained until upcoming data provide confidence that inflation is on a sustained path to 2%, which may take some time. Given the persistently high and unacceptable level of inflation, some participants commented that historical experience cautions against premature monetary easing. The hike ended the Fed's fourth consecutive 75 basis point rate hike, while raising the target range for the benchmark federal funds rate to 4.25% to 4.5%, the highest level in 15 years. Officials also said they would focus on the data and felt flexibility and optionality needed to be maintained when it comes to policy. Officials further warned that the public should not overinterpret the Federal Open Market Committee, which sets interest rates, to slow the pace of rate hikes. Some participants stressed that it is important to clearly communicate that the slowdown in the pace of rate hikes does not mean the committee's determination to achieve its price stability objective has diminished, nor that inflation is on a sustained downward path, the minute said. Fed Chairman Jerome Powell said after the meeting that despite some progress in fighting inflation, he only saw signs of stagnation and expected rates to remain elevated even after rate hike stops. The minutes reflected that sentiment, noting that no FOMC member expected a rate cut in 2023, despite market pricing. The Fed also expressed concern that the market misread policy. Fed officials last month stressed their determination to fight inflation and warned that an unreasonable easing of financial conditions would undermine the Fed's effort to achieve price stability. Ahead of the meeting, markets expect the Fed to cut interest rates in the second half of 2023. Participants noted that easing financial conditions, especially if there is a public misunderstanding of the committee's response, will make the committee's work restoring price stability more difficult, as monetary policy plays an important role through financial markets as a whole. Senior market analyst at Oanda wrote in a note to clients, U.S. stocks cannot sustain Tuesday's morning's gain as restrictive policies and recession fears remain something investors need to face and focus on. He believes that dip-grabbing buying was what triggered another bear market rally in U.S. stocks on Tuesday morning, but that rally didn't last long. The head of macroeconomics at Lombard Odier Investment Management said, "The basis for the stock market rally is that central banks are doing what they have never done before, soft landings. This still leaves us worried that there could be problems that could have a very negative impact on our portfolio, and caution remains the key word this year." Dan Niles, founder of the hedge fund Satori Fund, said Tuesday that the S&P 500 would fall more than 20% from current levels as businesses and investors continue to feel the pressure from the Federal Reserve's effort to curb inflation. The Satori Fund has set a target of 3,000 for the S&P 500, compared to the current level of around 3,800. Mark Dundee, chief economist at Moody Analytics, says that even the U.S. avoids a recession in 2023, U.S. consumers and investors could face a difficult period of slowdown, likely into 2024. Dundee calls this protracted slump chronic decline. That's all I have for you today. Thank you for listening. Don't forget to subscribe and like. See you next episode.